Before we begin, please remember that I am not a licensed financial advisor, attorney, or mortgage professional. This presentation is for informational and educational purposes only and should not be considered financial or legal advice. The home buying process is complex and unique to each individual. Always consult with qualified professionals before making any financial decisions. I'll never forget the feeling. Sitting at a cold, sterile closing table for my first house, a stack of paper an inch thick staring back at me. My hands were clammy. My heart was pounding. I was about to sign my name to the biggest financial commitment of my life. The closing agent, a nice enough person, was flipping through pages pointing, "Sign here, initial here and sign here." And then she slid a document across the table. It was called the closing disclosure. It was 3 pages of pure financial chaos. A wall of numbers, line items, and acronyms I had never seen before. Appraisal fee, underwriting fee, processing fee, courier fee, tax service fee, flood certification fee. It just kept going. I felt a knot in my stomach. Felt wrong. It felt like I was being taken for a ride, like I was at a casino where the house always wins, and I didn't even know the rules of the game. And you know what? I later found out that I overpaid by nearly $2,000 on fees that were either completely bogus or wildly inflated. $2,000. Gone. Poof. Just for the privilege of being confused and intimidated. Today I'm going to make sure that never ever happens to you. Because my story isn't unique. This exact scenario plays out in hundreds of thousands of closing offices across America every single year. Good, hardworking people, families trying to achieve the American dream, are getting systematically fleeced by a system designed to be confusing. They count on you being too excited, too nervous, or too overwhelmed to question the numbers. They hide behind jargon and endless paperwork, turning what should be a transparent transaction into a financial fog. The average American homebuyer pays between 2 and 5% of their loan amount in closing costs. On a $400,000 home, that's up to $20,000. And I'm here to tell you that a significant portion of that is often what the industry itself calls junk fees. These are redundant, padded, or downright fabricated charges that go straight into the lender's pocket. It's a multi-billion-dollar industry built on your confusion. But not anymore. By the time this video is over, you are going to have a superpower. You will be able to look at a loan estimate or a closing disclosure and see it not as a confusing mess, but as a roadmap. You'll be able to spot these junk fees from a mile away. You will know exactly what's negotiable, what's a legitimate cost, and what is a flat-out scam. More importantly, you'll have the exact words, the precise questions to ask to challenge your lender, and force them to justify every single dollar they are asking you for. This isn't just about saving a few $100 on a courier fee. This is about potentially saving thousands of dollars and, more importantly, taking back control of the single biggest purchase of your life. This is about transforming you from a passive participant into an empowered, educated consumer who cannot be taken advantage of. So let's pull back the curtain. Let's dive into the belly of the beast. The first thing you need to understand is that not all closing costs are created equal. They generally fall into 3 buckets: lender fees, third-party fees, and prepaid items. We're going to tackle them all, but we have to start with the one where the most games are played: the lender's own fees. These are the charges your bank or mortgage company charges you directly for the service of creating your loan. This is their profit center. And this is where you'll find the holy trinity of junk fees: the application fee, the processing fee, and the underwriting fee. Let's break this down. The application fee. Some lenders will try to charge you a fee right up front just to apply for the loan. Let me be crystal clear. In today's competitive market, you should almost never pay an application fee. Think about it. You are the customer. You are bringing them business that will make them tens, if not hundreds of thousands of dollars in interest over the life of the loan. Why should you pay them for the privilege of giving them your business? It's like a restaurant charging you a fee just to look at the menu. If a lender insists on a non-refundable application fee before they've even given you a loan estimate, it's a massive red flag. Walk away. There are plenty of other lenders who will be thrilled to have your business for free. Next, we have the dynamic duo of deception: the processing fee and the underwriting fee. On your loan estimate, you will almost always see these as 2 separate line items, often costing anywhere from $500 to over $1,000 each. Here's the dirty secret the industry doesn't want you to know. Processing and underwriting are 2 parts of the exact same job. The processor is the person who gathers all your documents, your pay stubs, your bank statements, your tax returns, and puts them into a neat little package. The underwriter is the person who then reviews that package and makes the final decision to approve or deny the loan. It is, for all intents and purposes, one continuous workflow. So why are you being charged twice? It's called unbundling. Lenders take one single service, the service of originating your loan, and they break it down into a dozen smaller official-sounding fees to make it seem like you're paying for a lot of distinct important work. It's a psychological trick. A single $2,000 origination fee looks scary and makes you want to negotiate. But a $500 processing fee, a $900 underwriting fee, a $200 admin fee, and a $150 funding fee? They all sound smaller, more reasonable. They're hoping you won't add them all up. But you should. You absolutely must. When you see these fees, your first question to the loan officer should be simple and direct. Can you please explain to me the difference between your processing fee and your underwriting fee, and why I'm being charged separately for two functions that are part of the core service of creating my loan? Just asking this question signals that you are not an easy mark. Tells them you've done your homework. Often they'll stumble. They'll give you some corporate speak about different departments. Don't accept it. Your response should be, I understand they may be different departments, but from my perspective as the customer, this is all part of the single service of originating the loan. I'd like to see these fees consolidated and reduced. Here is a powerful rule of thumb you can use right now. Add up every single fee the lender is charging you directly. I'm talking about anything with names like origination, points, processing, underwriting, administration, document prep, or funding fee. Ignore the third-party stuff like appraisal and title for a moment. Just their fees. That total number should not exceed 1% of your total loan amount. If you're getting a $400,000 loan, their total haul should be no more than $4,000. If it's significantly higher than that, you are likely being overcharged and you have a strong case for negotiation. They might come back and say, oh, but our fees are fixed, they're non-negotiable. That is almost always a lie. The lender's own fees are the most negotiable part of the entire transaction. This is their pure profit. They have complete control over these numbers, and they can and will reduce them to earn your business if they know you're a serious, educated borrower who is shopping around. Remember, you have all the power until you sign those final papers. They want your business. Make them earn it. But the lender's internal junk fees are really just the opening act. The main event, the real minefield where thousands of dollars can vanish, is in the murky world of third-party charges. These are the fees for services provided by other companies, the appraiser, the title company, the credit reporting agencies. And your lender will often tell you, sorry, we have no control over those costs, we're just passing them along to you. And that, my friends, is one of the biggest and most expensive lies in the entire mortgage industry. And we're going to expose exactly how that shell game works right after this. Okay, let's pull back the curtain on that shell game. The idea that a lender has no control over third-party fees is technically true, but masterfully deceptive. It's like saying you have no control over the price of a steak at a restaurant. That's true. You can't haggle with the chef, but you absolutely have control over which restaurant you walk into. And that is the entire secret. Your lender is the one choosing the restaurant. They are the ones who select the appraiser, the title company, the credit reporting agency, and all the other so-called third-party vendors. And here's where it gets dirty. They don't always choose the best or the most affordable option for you. They often choose the vendor that gives them, the lender, the best deal. Sometimes that means a kickback, sometimes it's an affiliated business arrangement, and other times it's just a simple, blatant markup. They buy the service for X and sell it to you for Y, pocketing the difference. This is the hidden profit center of the mortgage industry. While you're busy negotiating 0.25% on your interest rate, they're quietly adding hundreds, even thousands of dollars in padded fees, hoping you're too overwhelmed to notice. So how do we fight back? We start with their own playbook. When you apply for a loan, federal law requires the lender to give you a document within 3 days. It's called the loan estimate, or LE. Most people glance at the interest rate and the monthly payment and then file it away. Do not do this. This document is not a summary. It's a treasure map. It shows you exactly where the bodies are buried. Look at page 2 of your loan estimate. You'll see a section, usually section C, titled Services You Can Shop For. This is the most important and most ignored section of the entire home loan process. The services listed here are the ones the lender has chosen for you, but that the law says you have the right to replace. This is your battleground. This is where you take back control. Let's dissect the 3 biggest offenders you'll find in this section. First up, the appraisal fee. An appraisal is an independent opinion of your home's value, required by the lender to make sure they aren't lending you more money than the house is worth. The fee for this service on your loan estimate might say something like $700, maybe even $900 in a high-cost area. Seems reasonable, right? A professional has to come out, inspect the property, and write a detailed report. Here's the shell game. Your lender doesn't just call up a local appraiser. They typically use what's called an appraisal management company, or an AMC. The AMC acts as a middleman. The lender orders the appraisal through the AMC for, let's say, $750. The AMC then goes out and finds an appraiser to do the actual work. But they don't offer that appraiser $750. They might offer them $500. The appraiser agrees, does the work, and the AMC pockets the $250 difference for doing little more than sending a few emails. You just paid a $250 fee to a middleman you never knew existed, for a service that adds zero value. The lender claims they have no control over that fee, but they are the ones who chose to use that specific expensive AMC. They could have chosen a cheaper one, or in some cases a local appraiser directly, but they didn't. Why? It's often easier for them, and they have cozy relationships with these companies. Gets even worse. Next, let's talk about the absolute king of junk fees, title and settlement charges. This is where you can get completely fleeced if you're not paying attention. On your loan estimate, you'll see a whole bunch of confusingly named fees: title search, settlement fee, escrow fee, lender's title insurance, owner's title insurance. It's designed to be overwhelming. Let's simplify. When you buy a house, you need to make sure the seller actually has the legal right to sell it. A title company does the research, the title search, to make sure there are no old debts, liens, or long-lost relatives who have a claim to the property. Then they issue an insurance policy called a lender's title insurance policy that protects the lender in case they miss something. They'll also try to sell you an owner's title insurance policy, which protects you. The shell game here is enormous. The cost for these services can vary by thousands of dollars from one company to another. And guess what? Your lender has a favorite. Very often, large lenders own their own title companies or have what's called an affiliated business arrangement, or AFBA. They will automatically steer you to their in-house or partner company. They'll tell you it's for convenience or to streamline the process. What it really means is they get to double dip. They make money on your loan, and they make money on your title insurance. And you can be sure their affiliated company isn't the cheapest one on the market. They hide the profit in plain sight using a barrage of different fee names. You might see a settlement fee for $500, an escrow fee for another $500, and a document prep fee for $200. In reality, these are often just different names for the work the title and escrow company does to handle the paperwork for the closing. Another company might bundle all of that into one single closing fee for $600. By splitting it up and giving it official-sounding names, the lender's preferred company makes it look standard, when in fact it's just a bloated invoice. Remember Section C? Services you can shop for. Title and settlement services are the #1 item on that list. You have the absolute, federally protected right to choose your own title company, and almost nobody does it. Finally, a smaller but classic example, the credit report fee. The lender needs to pull your credit history from the 3 major bureaus: Equifax, Experian, and TransUnion. This is called a tri-merge report. On your loan estimate, you might see a fee for this listed as $75, $100, even $150 for 2 borrowers. The actual cost to the lender for that report? About $40, maybe $50 tops. The rest is pure, unadulterated markup. They'll tell you it's an administrative fee to cover the cost of their system that orders the report. It's nonsense. It's a $100 profit they're making just for typing your name into a computer. Again, they chose the credit vendor and they set the price they charge you. They have total control. So you have padded appraisal fees, bloated and duplicated title charges, and marked up credit reports. Individually, they might seem like minor annoyances, but add them up. A $250 appraisal markup, $1,000 in extra title fees, a $100 credit report padding. You're suddenly paying over $1,300 in pure junk. That's a new refrigerator. That's a flight for a family vacation. It's your money, and it's being siphoned out of your pocket through a system designed to confuse and overwhelm you. They get away with it because of psychology. They know you're stressed. You're emotionally invested in buying this house. You're trying to compare interest rates and loan programs, and your brain is already at full capacity. You trust the person on the other end of the phone, your loan officer, to be your guide. You assume they're on your side. And they use that trust to slide these fees right past you, camouflaged as the standard cost of doing business. They're counting on you not knowing the rules of the game. But now you do. You know about the loan estimate. You know about Section C. You know that the appraisal, title, and credit fees are not set in stone. You know that we have no control is a lie. Knowing the game is one thing. Winning it is another. So, now that you can spot the shell game, how do you actually call their bluff? How do you shop for these services? What do you say? What emails do you send to make them drop these fees without jeopardizing your loan? That's the million-dollar question, or at least the several $1,000 question. And in the next part, I'm going to give you the exact playbook. I'm going to arm you with the precise scripts and the step-by-step strategy to challenge these fees and force your lender to compete for your business, saving you thousands in the process. Alright, the playbook. Let's get right into it. The first rule of this game is simple. You cannot win if you don't know the score. And in the world of home loans, the scoreboard is a 3-page document called the loan estimate. This isn't just a piece of paper. It's the battleground. It is the single most important document you will receive in the early stages of buying a home, and 95% of buyers just glance at the interest rate and the monthly payment and file it away. Do not be one of them. This document is your leverage. It's your negotiation blueprint. When you apply for a mortgage, federal law requires the lender to send you this standardized loan estimate within 3 business days. Your mission, should you choose to accept it, and you absolutely should, is to get this document from at least 3 different lenders. Why 3? Because 1 gives you no information, 2 gives you a comparison, but 3 gives you a pattern, 3 gives you an average, 3 turns you from a hopeful homebuyer into a market analyst. Now, once you have these in your hands, I want you to ignore page 1 for a moment. Yes, I said ignore it. We'll get to the interest rate, but that's not where the first fight is. The first fight is on page 2. Specifically, Section A, origination charges. This is the lender's playground. This is their profit center, cleverly disguised as the cost of doing business. These are the fees they have direct 100% control over. And this is where we draw our first line in the sand. You're going to see a list of items here. Things like an application fee, a processing fee, an underwriting fee, maybe a loan origination fee, listed as a percentage. To the untrained eye, these look official. They sound non-negotiable. They are anything but. Let's be crystal clear. An application fee? That's just a fee to fill out a form. In today's market, it's the equivalent of a restaurant charging you for a menu. A processing fee? That's the lender charging you for their employee to collect your documents and put them in a folder. An underwriting fee? That's them charging you for their other employee to look at that folder and make a decision. These are the fundamental costs of their business. Charging you for them separately is like going to a steakhouse and getting a bill for the steak, plus a separate cooking fee and a server fee. It's outrageous and you don't have to stand for it. So here is the strategy. Step 1. Get your loan estimates. Step 2. Pick one lender, preferably the one you feel you have the best rapport with, and you're going to make a call. Before you dial, have their loan estimate in front of you, a pen and a piece of paper. You are going to be polite, you are going to be friendly, but you are going to be firm. You are a student of the game now. Here is the script. Write this down. You call your loan officer, let's call him Bob. Hi Bob, it's your name. Thanks for sending over the loan estimate for the property on Elm Street. I've got it right here and I'm just going through it. I have a couple of quick questions on the fees, specifically in Section A, the origination charges. Do you have a minute? You've set the stage. You're professional, and you've directed him to the exact part of the document you want to discuss. He'll say yes. Now you go line by line. Let's start with the application fee. You say, okay, great. I'm looking at line 1, and I see an application fee of $500. Now, from the research I've done and in speaking with other lenders, my understanding is that this fee is often waived to earn a new customer's business. Is that something you can do for me? Let's break down why this works. You didn't accuse him of ripping you off. You didn't get angry. You framed it as a standard industry practice. You used the phrase, earn my business. This is powerful. It subtly reminds him that you are the prize, that he is in competition. You're not asking for a favor. You're asking him to meet the market standard. He might say, well, that covers the cost of pulling your credit and starting the file. Your response is ready. You say, I understand that, but other lenders seem to absorb that as a cost of acquiring a new client. I'd like to work with you, but paying a $500 fee just to apply is a difficult starting point. I need you to waive that fee for us to move forward. See the shift? You went from a question to a statement. Calmly, confidently. Next, you move down the list. Let's say you see a processing fee of $795 and an underwriting fee of $995. These are the big ones. They are pure junk. Here's your script for that. You say, okay, moving on. I see the processing fee for $795 and the underwriting fee for $995. Together, that's nearly $1,800. To be honest, Bob, that's much higher than what I'm seeing on other estimates. Some lenders are combining these into a single, much lower administrative fee. Can you explain why these are broken out and priced so high? Again, the psychology here is key. You're not demanding he lower it, not yet. You're asking him to justify it. You're making him do the work. You're putting him on the defensive by showing him you have other data points, your other loan estimates. This is why getting 3 is non-negotiable. It's your ammunition. Now he's going to give you some prepackaged answer. He'll say, well, that's our standard fee structure. It covers the extensive work our team does to get your loan approved. This is the moment of truth. This is where most people fold. You will not. Your counterscript is crucial. You say, I appreciate that it might be your standard structure, but my goal is to secure the loan with the best overall value. And right now, $1,800 in administrative fees is making your offer less competitive. I know you guys have a great reputation, and that's why I called you first. What can you do to significantly reduce or combine these fees to be more in line with the market? Boom. You complimented him. Great reputation. You made him feel like he's your first choice. Called you first. And then you brought it right back to the central problem. His price is too high. You used the word significantly. You're not asking for $100 off. You're asking for a real change. The golden rule of this first call is this. Do not, under any circumstances, mention the interest rate. Not once. This call has one purpose and one purpose only, to attack the junk fees in Section A. If you try to negotiate the rate and the fees at the same time, you give the loan officer an easy way out. He'll say, well, I can lower the fees, but I'll have to raise the rate, or vice versa. He'll confuse you by talking about points and credits. Don't let him. Keep the conversation laser-focused. One battle, one victory at a time. Today we fight on fees. Tomorrow we fight on the rate. The goal of this call isn't even necessarily to get an immediate yes. The goal is to fire a warning shot. The goal is to completely reframe your relationship. You have just transformed from a random applicant into a sophisticated, educated consumer who is actively shopping and comparing offers. You've put him on notice. He now knows that if he wants your business, he's going to have to sharpen his pencil. End the call by saying, okay, Bob. Thank you for looking into that. Why don't you see what you can do on those fees and send me over a revised loan estimate when you have it? I'm looking to make a decision in the next few days. You've given him a task and a deadline. You are in control. Now what he does next is telling. He might come back with a reduced offer right away. Fantastic. But more likely he'll wait. He's playing a game of chicken, hoping your other offers aren't as good as you claim. And that's perfectly fine. Because he has no idea what we're about to do next. We're going to take his loan estimate and our newfound knowledge and orchestrate a bidding war for our business. In the next part, I am going to show you how to take this initial conversation and use it as a crowbar to pry open even better deals from other lenders, forcing them to compete against each other in a race to the bottom, a race that you are guaranteed to win. Alright, let's talk about the single most powerful document in the entire home buying process. It's not the purchase agreement. It's not the deed. It's a simple 3-page government form called the loan estimate. This document is your crowbar. It is the weapon you will use to force lenders into a brutal price war for your business. And by the end of this, you'll know how to wield it with surgical precision. When you officially apply for a loan, a lender is required by federal law to give you this standardized loan estimate within 3 business days. The key word here is standardized. Thank the Consumer Financial Protection Bureau for this, because back in the day, every lender had their own confusing form, making it impossible to compare apples to apples. It was a jungle designed to confuse you. Now it's a level playing field, and we're going to use that to our absolute advantage. The moment you get that first loan estimate, the game begins. Don't get emotionally attached to the first lender you spoke to. Their only role was to give you the starting pistol for the race. Your loyalty is not to them. Your loyalty is to your bank account and your future financial freedom. So, you have the document from lender A. What now? You're going to contact at least 3 to 5 other lenders. Banks, credit unions, online lenders, mortgage brokers cast a wide net. And you're not going to call them up and say, "Hey, what are your rates?" That's an amateur move. That's what everyone else does. And it gets you a vague, non-committal answer. You're going to be a professional. You're going to email them, and your email is going to be short, direct, and powerful. The subject line will be, Loan Estimate Comparison, your name, property address. In the body of the email, you will write something like this. Hello. I am under contract for the property at property address. For purchase price. I have a FICO score of your score and I am putting your down payment % down. I have already received an official loan estimate from another lender. I have attached a redacted copy for your review. Please provide me with your competing loan estimate within 24 hours so I can make a decision. I am looking for the best combination of interest rate and lowest lender fees. Thank you. Let's break down why this is a killer approach. First, you sound like you know exactly what you're doing. You're not a tire kicker. You're a serious buyer with a property already under contract. Second, you've given them all the essential information they need. Price, score, down payment. This cuts out the back and forth. Third, and most importantly, you've shown them your cards. By sending them the competitor's loan estimate, you've told them, this is the number you have to beat. Don't waste my time with a standard offer. You've immediately framed the conversation as a competition. Now, why a redacted copy? You can use a simple PDF editor, or even just a marker to black out the name of the competing lender, and any personal identifying information you're not comfortable sharing. You don't want them calling each other. You want them operating in the dark, forced to put their best foot forward solely based on the numbers they see. Within a day or two, your inbox will start filling up with new loan estimates. This is where the magic happens. You're going to lay them all out side by side. Your eyes will naturally go to the interest rate on page 1. And yes, that's important. But it is not the most important thing. The real battle is fought in the fees. Specifically, you need to look at page 2, in the box labeled Loan Costs, and focus like a laser on Section A, Origination Charges. This is the lender's pure profit. This is the money they charge you just for the privilege of giving them your business for the next 30 years. You'll see line items like application fee, processing fee, underwriting fee, or just a generic origination fee. This is the soft underbelly. These are the numbers that have the most wiggle room. One lender might charge you a $900 processing fee and a $1,200 underwriting fee. Another might lump it all together into a $2,500 origination fee. A third, highly competitive lender might have zero, or just a few $100s in total. This is where you find thousands of dollars in savings. So you analyze all your new offers. You find lender B, who has come in with a slightly better interest rate and has $1,500 less in Section A fees than your original lender A. Now you pick up the phone. You call your loan officer at lender A, and you say this, "Hi, loan officer name. It's your name. I appreciate you putting together that initial loan estimate for me. I've been doing my due diligence and I've just received a competing loan estimate from another lender that is significantly better. They're offering me the same loan type at new, lower interest rate, and their total origination charges in Section A are only new lower fee amount, which is $1,500 less than your offer. I really enjoyed our conversation and would prefer to work with you, but the numbers need to make sense. Can you match or beat this offer?" And then you do the most important thing of all. You stop talking. You let the silence hang in the air. What you've just done is masterful. You didn't get angry. You didn't make a vague demand for a better deal. You presented a factual, undeniable, competing offer. You complimented them. "I'd prefer to work with you," which makes them want to keep you. And you put the ball squarely in their court. Their commission, their monthly quota is now on the line. 9 times out of 10, you will hear a frantic typing sound in the background. They'll say, okay, let me talk to my manager and see what I can do." They are not talking to their manager. They are plugging numbers into their system to see how much of their commission they can sacrifice to keep the deal alive. A few hours later, you'll get a call back or a new email with a revised loan estimate. Magically, those fees have dropped. The interest rate might have ticked down. They've matched the offer. But we're not done. Oh no, we're just getting started. You now take lender A's new better offer and you go back to lender B. You say, "Thank you for this offer. It was the best one I had received. I just heard back from another lender who has now agreed to match your rate, but they've also dropped their fees even lower, to just an even lower fee amount. Can you do any better?" You see what's happening? You are creating a reverse auction. You are the prize, and these multi-billion-dollar financial institutions are bidding against each other, lowering their prices, sacrificing their profits, all to win your business. You can do this 2, 3, 4 times. You can bring in a lender C and a lender D to create even more chaos and competition. You continue this process until one of them says, "I'm sorry, that's the absolute best I can do. I can't go any lower." That's when you know you've hit the bottom. That's when you know you have squeezed every last possible dollar out of the deal. This single strategy can save you thousands of dollars in closing costs up front, and tens of thousands of dollars over the life of the loan from securing a lower interest rate. This is the power they don't want you to know you have. They want you to feel grateful that they are even considering giving you a loan. They want you to be timid. But you hold all the cards because your mortgage is a massively profitable financial product, and they want it. You have now forced the lenders to their knees and secured a deal that will save you a fortune. But the fight isn't over. In fact, the most treacherous part of the entire process is just beginning. It's called underwriting, and it's where a tiny mistake, a single misplaced document, or one unexplained bank deposit can cause your entire deal to collapse, costing you the house and your earnest money. In the next part, I'm going to show you how to navigate this minefield and bulletproof your application, so that nothing can stop you from getting those keys. So let's talk about how to build that bulletproof application. Imagine your loan application isn't just a stack of papers, it's a fortress. And the lender's underwriter? They're the siege engine designed to find every single crack, every weak point in your financial walls. Their job isn't to be mean. Their job is to protect the lender's investment. If they approve a loan that goes bad, it's on them. So they are meticulous, they are thorough, and they are unforgiving. To survive their scrutiny, you need to understand the 3 pillars they will test relentlessly: your credit, your capacity, and your cash. Get any one of these wrong and your fortress crumbles. Let's start with the first pillar, credit. This is more than just a 3-digit number. It's the story of your financial reliability. Most people think, "My credit score is 780, I'm golden," and they stop paying attention. This is a catastrophic mistake. Let me tell you about a couple, we'll call them Mike and Jessica. They had great scores, a solid pre-approval, and they were 2 weeks from closing on their dream home. Then they get a frantic call from their loan officer. The deal is on hold. Why? Because Mike's credit score had suddenly dropped 30 points. It was still a good score, but it was just enough to knock them into a different risk tier, which meant their interest rate was no longer valid. The new, higher rate pushed their monthly payment just over the edge of what the lender would approve. The deal was about to collapse. After days of panic, they discovered the cause. 6 months earlier, Mike had co-signed on a $1,200 furniture loan for his younger brother, who had just gotten his first apartment. Mike had completely forgotten about it. But his brother, being a typical 22-year-old, had missed a payment 2 months ago. That single late payment on a tiny loan he didn't even remember co-signing for was about to cost them a $400,000 house. They managed to save the deal by paying a rate lock extension fee and having Mike's parents wire money to pay off the entire furniture loan immediately. But it was a nightmare. The lesson here is profound. From the moment you get pre-approved until the day you have the keys in your hand, you must treat your credit report like a newborn baby. You monitor it constantly. You protect it fiercely. Do not open any new lines of credit. Don't apply for a new credit card to get 10% off at a department store. Don't finance a new lawnmower. And for the love of God, do not co-sign for anything or anyone. Your financial life is on lockdown. The underwriter will pull your credit again, sometimes just hours before closing, in what's called a soft pull. They are looking for any new inquiries or new debt. If they find it, it's a giant red flag that can derail everything at the 11th hour. That brings us to the second pillar, capacity. This is your ability to handle the debt, measured by something called your debt-to-income ratio, or DTI. This is, without a doubt, the #1 reason that perfectly good-looking loan applications get rejected. DTI is simple in theory. It's all your monthly debt payments, student loans, car payments, credit card minimums, divided by your gross monthly income. Lenders have very strict limits on this, usually around 43%, but sometimes a little higher for certain loan types. Let's go back to our couple, Mike and Jessica. Let's imagine the credit score wasn't the issue. Let's say a week after getting pre-approved, Jessica decides their 10-year-old sedan isn't going to cut it for their new suburban life. She goes out and finances a brand new SUV. It seems logical, right? Get the car sorted before the chaos of moving. But that new $600 a month car payment just detonated their DTI. Their income hadn't changed, but their monthly debt obligations just shot up. When the underwriter reran the numbers for final approval, their DTI was now 47%. Application denied. Deal dead. This happens every single day. People make large purchases between pre-approval and closing, thinking they're fine because the money isn't coming from their down payment savings. But the lender isn't just looking at your savings, they're looking at your monthly cash flow. That new payment, whether it's for a car, a boat, or a living room set from We Finance Everyone, is a new long-term claim on your future income. It reduces your capacity to pay your mortgage, and the underwriter will catch it. The rule is simple. If it involves a credit check or a new monthly payment, you do not do it. You don't change jobs, you don't switch from salary to commission, you don't start a new business. You become as financially boring as possible until after you close. Now for the third and perhaps most treacherous pillar, cash. Specifically, the cash you're using for your down payment and closing costs. You'd think having the money in your bank account is all that matters. You would be dangerously wrong. Lenders are legally required by federal law, including the Patriot Act, to verify the source of every single dollar you use. They are looking for two things: that the money is legally yours and that it isn't a secret, undisclosed loan that would mess up your DTI. This is where the concept of seasoned funds comes in. Lenders want to see that the money has been sitting in your account for at least 2 full bank statement cycles, which is typically 60 days. Money that has been seasoning for that long is considered yours. No questions asked. But any large, recent, unseasoned deposit is a massive problem. Let's imagine Mike and Jessica's credit and DTI are perfect, but their down payment is a little short. So Jessica's parents generously offer them $20,000 as a gift. They hand her a cashier's check. She deposits it into her savings account, and they think they're all set. A week later, the underwriter flags it. "What is this $20,000 deposit from last Tuesday?" they ask. Jessica says, "It's a gift from my parents." The underwriter says, "Prove it." And now the scramble begins. They need a signed gift letter from her parents, a legal document stating the money is a true gift with no expectation of repayment. They also need proof the money came from her parents' account, which means Jessica has to go back to her parents and ask for a copy of their bank statement showing the withdrawal, and a copy of the cashier's check. This can be awkward and cause delays. But what if her parents had given her cash? What if they'd saved it up over years in a safe at home? This is an underwriter's worst nightmare. You can't trace the source of physical cash. For all the lender knows, it could be from an illegal source or, more likely, a loan from a friend that you have to pay back. If you can't paper trail it, you can't use it. End of story. Any cash gift must be handled carefully. The gift giver should wire the money directly to escrow or provide a cashier's check, along with a fully executed gift letter and proof of funds. Don't just deposit a big chunk of cash and hope no one notices. They will always notice. Each of these missteps, the co-signed loan, the new car, the unverified cash deposit, doesn't just risk your loan approval. Costs you money. A credit score drop can push you into a higher interest rate or a more expensive type of mortgage insurance, costing you tens of thousands over the life of the loan. A delay caused by a DTI or cash sourcing issue can force you to pay a rate lock extension fee, which can be thousands of dollars out of pocket just to keep your interest rate from expiring. And if the deal collapses entirely, you lose your earnest money deposit. You lose the money you spent on the appraisal. You lose the money you spent on the home inspection. You lose the house. You can prevent all of it by understanding that you are under a financial microscope. By bulletproofing these 3 pillars, credit, capacity, and cash, you remove any reason for the underwriter to say no. You make their decision easy. You sail through to the closing table. But even with a perfect application and an ironclad approval, there's one more major hurdle that can appear out of nowhere and demand thousands of dollars you never planned to spend. It's an independent player in this game whose opinion can override everyone else's and completely change the math on your deal, forcing you back to the negotiating table or killing the sale entirely. It's not the lender, it's not the seller. It's the appraiser. And in the next part, we're going to break down the appraisal gap, the hidden landmine that's blowing up deals for unsuspecting buyers all across the country. So let's talk about this landmine. Imagine you're in a heated bidding war for your dream home. It's listed at $500,000, but you know you have to go big to win. You stretch, you push your budget to the absolute limit, and you offer $550,000. And you get it. The seller accepts your offer. You're ecstatic, you're calling your family, you're mentally arranging furniture. The deal is done, right? Not even close. Because now, your lender, the bank giving you the mortgage, steps in. And they have one very important question. Is this house actually worth the $500,000 plus that you've promised to pay for it? They aren't just going to take your word for it. They need proof. Why? Because that house isn't just your home. To the bank, it's the collateral. It's their insurance policy. If you stop making payments, they need to be able to foreclose, sell the house, and get their money back. If they lend you $450,000 on a house that's only worth $400,000, they've already lost $50,000 from day one. They will not take that risk. So they order an appraisal. They hire a neutral third-party appraiser to go out, inspect the property, and determine its fair market value. This appraiser doesn't care about your winning bid. They don't care about the seller's asking price. They care about one thing: data. They look at what similar homes, the comparables or comps, have sold for in that neighborhood in the last 90 days. They measure square footage, they count bedrooms, they look at the condition of the roof and the age of the furnace. They are cold, hard fact finders. And then the report comes back. The appraiser looks at all the data and concludes that the house, despite your generous offer, is only worth $520,000. And that $30,000 difference between your $550,000 offer and the $520,000 valuation, that, my friends, is the appraisal gap. And it's a financial nightmare, because the lender will now only give you a loan based on the appraised value, the lower number. Let's break down what this actually means for your wallet. You agreed to pay the seller $550,000, but the bank is saying, we only believe the house is worth $520,000, so that's the number we're going to use to calculate your loan. Suddenly, that $30,000 gap becomes your problem. You have to come up with that $30,000 in cash on top of your planned down payment, on top of your closing costs. Your cash to close amount just exploded. For the vast majority of buyers, finding an extra $30,000 in a matter of weeks is simply impossible. The dream home becomes a trap. The celebration turns into panic. This isn't some rare freak occurrence. In any competitive housing market, this happens every single day. Bidding wars force prices up at a pace that the historical sales data, the very data appraisers rely on, can't keep up with. Buyers are paying for tomorrow's value, but appraisers are required to look at yesterday's sales. That lag creates the gap. It's a systemic problem in a hot market. So what happens now? The deal is on the brink of collapse. You, the buyer, are panicking. The seller, who thought they had a $550,000 sale in the bag, is now realizing their deal might evaporate. Everyone loses. This is the moment where you have four primary options and none of them are perfect. Option 1, you somehow find the money. You drain your emergency fund, you borrow from family, you sell your car. You bridge that $30,000 gap with your own cash to save the deal. It's painful, and it leaves you financially vulnerable right as you take on the biggest debt of your life. Option 2, you go back to the seller hat in hand and ask them to lower the price to the appraised value. You ask them to drop their price from $550,000 down to $520,000. Why would they do this? Because if your deal falls through, they have to put the house back on the market. That new listing will carry a stigma. Other agents and buyers will wonder, what's wrong with the house? Why did the first deal die? The seller might agree to the price cut just to be done with the stress and uncertainty, but they're losing $30,000 they thought they had. Option 3, you meet in the middle. This is the most common outcome. You go to the seller and say, look, I can't come up with the full $30,000, but I can find an extra $15,000. Can you meet me halfway and lower the price by $15,000? If both sides agree, the new price is $535,000. The buyer has to bring more cash than they planned, and the seller makes less money than they expected. Nobody is happy, but the deal survives. It's a painful compromise. Option 4, you walk away. If your purchase contract included an appraisal contingency, this is your escape hatch. A contingency is just a clause that says, I'll buy this house if certain conditions are met. An appraisal contingency says you can cancel the contract and get your earnest money deposit back if the home doesn't appraise for the purchase price. It's your safety net. But it also means you're back to square one, scrolling through listings, going to open houses, and starting the entire soul-crushing process all over again. Now, here's the pro-level strategy for dealing with this in a competitive market. It's called an appraisal gap clause. When you make your initial offer, you can write this directly into the contract. It's a statement that tells the seller you are prepared for a potential low appraisal. It might say something like, "Buyer agrees to pay up to $20,000 over the appraised value, not to exceed the purchase price." Think about how powerful that is from the seller's perspective. They get two offers. One is for $550,000. The other is for $545,000, but it includes a $20,000 appraisal gap clause. Which offer gives them more peace of mind? The second one. It shows that the buyer has extra cash reserves and is committed to closing the deal, even if the appraisal comes in low. Your offer isn't just about the highest price. It's about the certainty of closing. An appraisal gap clause is one of the most powerful tools a buyer has to make their offer stand out in a bidding war. So the appraisal gap isn't a fee, not in the traditional sense. You don't see it on your loan estimate as a line item. Instead, it's a phantom cost, a potential financial shockwave that can tear a deal apart. It's a direct tax on buying a home in a competitive market. But let's say you navigate this. You bridge the gap, you renegotiate, you get the deal done. You've survived the appraisal. Now you can finally focus on the loan itself. And this is where we get back to the explicit, written down in your face fees. The ones the lender charges you for the simple privilege of loaning you money. These are the numbers on the page you can actually fight over, the ones where a little bit of knowledge can save you thousands of dollars up front. We're talking about the engine room of your mortgage costs, origination fees, discount points, and the murky world of lender credits. Let's start with the big one, the origination fee. Think of this as the lender's direct payment for their work. They're not a charity, they're a business. They have underwriters to pay, processors who chase down your paperwork, and a whole system designed to take your application from a hopeful, maybe, to a key in your hand, yes. The origination fee is how they cover those costs and turn a profit. It's the price of admission for the loan itself. Typically, this fee is expressed as a percentage of the total loan amount, usually somewhere between 0.5% and 1%. So, on a $400,000 loan, a 1% origination fee is $4,000. A 0.5% fee is $2,000. Right away, you can see how a seemingly small difference in percentage points translates into thousands of real dollars out of your pocket on closing day. Now, here's the secret most lenders won't shout from the rooftops. This fee is often negotiable. It's not set in stone. Lenders are competing for your business, and the origination fee is one of the easiest places for them to show some flexibility. When you have loan estimates from multiple lenders, you can go back to your preferred lender and say, "Look, I love working with you, but lender B is offering me the same interest rate with an origination fee that's $1,000 lower. Can you match that?" More often than you'd think, the answer is yes. They'd rather shave a bit off their profit margin than lose your entire loan, and the decades of interest payments that come with it, to a competitor. But be very, very wary of the no origination fee loan. It sounds like an incredible deal, a free pass. But in the world of mortgages, nothing is ever free. When a lender waives the origination fee, they almost always make up for it somewhere else, and that somewhere else is your interest rate. They might offer you a loan with zero origination, but the interest rate will be 1/8 or 1/4% higher than their standard loan. Let's run the numbers on that. Let's say you have two options on that same $400,000 loan. Option A has a $2,000 origination fee and a 6.5% interest rate. Option B has zero origination fee, but a 6.75% interest rate. You save $2,000 up front with option B. Fantastic, right? But that higher interest rate means your monthly principal and interest payment is about $70 more every single month for 30 years. After just 29 months, less than 2.5 years, you'll have paid more than $2,000 in extra interest, completely wiping out your upfront savings. And from that point on, for the next 27.5 years, you're just lighting an extra $70 on fire every month. The free loan ends up costing you over $25,000 in the long run. So, is it a scam? No. But is it a trade-off you need to be aware of? Absolutely. This brings us to the next powerful tool in the lender's toolbox: discount points. If a no origination fee loan is about paying less now for a higher rate later, discount points are the exact opposite. You are voluntarily choosing to pay more money up front in exchange for a lower interest rate for the entire life of your loan. It's essentially prepaid interest. Here's how it works. 1 point costs 1% of your loan amount. So on our $400,000 loan, 1 point costs $4,000. In exchange for paying that $4,000 at closing, the lender might reduce your interest rate by, say, 0.25%, from 6.5% down to 6.25%. This is where so many homebuyers get lost. Is it worth it? Should you pay points? The answer isn't yes or no. The answer is math. And the magic number you need to find is your break-even point. This is the moment in time when your monthly savings from the lower interest rate officially pay back the upfront cost of the points. Let's do this together. On our $400,000 loan, a 6.5% interest rate gives you a monthly principal and interest payment of about $2,528. If you buy 1 point for $4,000 and lower your rate to 6.25%, your new monthly payment is $2,462. Your monthly savings are $66. Now you take the total cost of the points, $4,000, and you divide it by your monthly savings, $66. The answer is 60.6. That means it will take you just over 60 months or 5 years to break even. This calculation is your crystal ball. Tells you everything. If you know with near certainty that you're going to live in this house for 10, 15, or 30 years, then buying points is one of the smartest financial moves you can make. After that 5-year break-even point, that $66 a month is pure savings, pure profit in your pocket for decades to come. Over the life of the loan, you'd save over $17,000. But what if you think you might be transferred for work in 3 years? What if you plan on starting a family and will need a bigger house in 4 years? If you sell or refinance the home before you hit that 5-year break-even point, you lose. You've paid $4,000 up front, and you haven't stayed long enough to reap the rewards. You essentially just gave the lender a very generous $4,000 tip for no reason. So, the decision to pay for points has nothing to do with the lender and everything to do with you and your life plan. How long are you staying? Answer that and you'll know whether to buy down your rate. Now let's look at the mirror image of discount points. What if you're in the opposite situation? What if you're not flush with cash? What if scraping together the down payment and closing costs is the biggest financial challenge you've ever faced? What if you need money from the lender to help you close, not the other way around? This is where lender credits come in. A lender credit is exactly what it sounds like. The lender gives you a credit, real money, to be applied toward your closing costs. They might offer you a $3,000 credit to help cover your appraisal fee, your title insurance, and other third-party charges. It sounds like a gift, but we already know the number one rule of mortgages. Nothing is free. In exchange for this credit, you have to take a higher interest rate. It's the reverse of discount points. Instead of you paying them to lower your rate, they are paying you to accept a higher rate. So the lender might say, the market rate today is 6.5%. But if you take a rate of 6.875%, we will give you a $3,000 credit to use at closing. When does this make sense? It makes sense when cash is your biggest obstacle. That $3,000 might be the difference between being able to close on your dream home and having the deal fall apart. It can be a lifeline for a first-time homebuyer who has saved diligently for a down payment, but is coming up short on the extra $10,000 or $15,000 needed for closing. Gets you in the door. But you have to understand the long-term cost. That higher interest rate will be with you every single month. On our $400,000 loan, a rate of 6.875% instead of 6.5% will cost you about $95 extra per month. Over the first 3 years alone, you'll have paid back that $3,000 credit in the form of higher interest. And if you stay in that loan for the long haul, that credit will end up costing you tens of thousands of dollars. The strategy here, if you take a lender credit, is often to get into the house and then refinance into a lower rate as soon as your financial situation improves and market rates are favorable. So you see, these 3 items, origination fees, discount points, and lender credits, are not just random line items on a form. They are the 3 levers that control the entire structure of your loan. They are a sliding scale, a spectrum of choice. At the center, you have a standard loan with a standard origination fee and a market interest rate. If you want to slide toward lower upfront costs, you can negotiate the origination fee down or take a lender credit, but your interest rate will go up. If you want to slide toward lower long-term costs, you can pay points to buy down your rate, but your upfront costs will be higher. Your job as a savvy homebuyer isn't to find a loan with 0 fees. It's to understand these trade-offs and to force your lender to explain them to you. Ask them to show you the options. Show me a loan with 1 point. Now show me a loan with a $2,000 lender credit. Now show me your standard option. By comparing these, you can see the direct relationship between what you pay now and what you pay later. You can align the loan structure not with what makes the lender the most money, but with what makes the most sense for your wallet, your cash flow, and your 5, 10, or 30-year plan. This is how you take control of the process. And a huge part of taking control is understanding who else has their hand in your pocket during this process. Because it's not just the lender. A mortgage isn't a simple transaction between you and a bank. It's more like a massive, complex project, and the lender is just the general contractor. They hire a whole crew of subcontractors to get the job done. And guess who pays every single one of their invoices? You do. These are called third-party fees, and they represent a minefield of potential overcharges and confusing line items. Think of it this way. The lender's own charges, like the origination fee we just talked about, are like the contractor's management fee. It's their direct profit. But then you have the invoices from the electrician, the plumber, the inspector. These are the third-party services. The lender coordinates them, but other companies perform them. And while some of these fees are fixed and non-negotiable, many are not. This is where knowledge truly becomes power. Let's start with one of the biggest and most important ones. The appraisal fee. Before a bank lends you hundreds of thousands of dollars, they need to be absolutely sure the asset they're securing the loan against, your new house, is actually worth that much. They aren't going to just take your word for it or the seller's. So they hire an independent appraiser to go out, inspect the property, compare it to similar recently sold homes, and provide a professional, unbiased valuation. You pay for this service, typically somewhere between $400 and $800, sometimes more for unique or large properties. This fee is paid up front, often as soon as you go under contract. Now here's the critical part. The appraiser is supposed to be a neutral third party, but the lender is the one who orders the appraisal from a list of approved professionals. You don't get to pick your cousin who's an appraiser. This is to ensure impartiality. The appraisal protects the bank, but it also protects you from overpaying for a property. If the appraisal comes in low, it can be a major roadblock, but it's also a sign that the price might be inflated. The fee itself isn't usually negotiable, but it's a crucial cost to anticipate right at the beginning of the process. Next up, a much smaller but ever-present fee. The credit report fee. This is exactly what it sounds like. The lender needs to pull your detailed credit history and FICO scores from the 3 major bureaus, Equifax, Experian, and TransUnion. They use a service to do this, and they pass that cost directly on to you. It's usually not much, maybe $30 to $60. You can't shop for it, you can't avoid it. It's just a non-negotiable cost of doing business. Consider it the entry ticket to the mortgage game. Now we get into the real heavy hitter. The one that causes the most confusion, has the biggest price tag, and is arguably one of the most important services you'll pay for: title fees. This isn't one fee, but a bundle of them, all related to ensuring you are getting clean, undisputed ownership of the property. The whole concept of title is a bit abstract, so let's make it simple. Title is your legal right to own, use, and sell your property. A title search is like a background check on the house itself. A company called a title company scours public records, deeds, mortgages, court records, tax documents, to make sure the person selling you the house actually has the legal right to sell it. They're looking for ghosts in the property's past. Are there any outstanding liens from a contractor who never got paid for a new roof 5 years ago? Is there an unpaid property tax bill? Did a previous owner's messy divorce result in a claim on the property from an ex-spouse? Is there a long-lost heir from the 1950s who could suddenly show up and claim the house is rightfully theirs? This stuff happens. And if it does, it can become your nightmare. The title search is designed to find these problems before you close. If they find something, it's called a cloud or defect on the title, and it has to be resolved before the sale can go through. The fee for this search is part of your closing costs. But the search itself isn't a guarantee. It's just a search. Things can be missed. Forgeries can exist. Clerical errors in the county courthouse can hide major problems. That's where title insurance comes in. And there are 2 different kinds, which is key. First, there's lender's title insurance. This is not optional. Your lender will require you to buy this policy. It protects their investment. If some title issue pops up after you close, and it jeopardizes the ownership of the property, this insurance policy pays off the lender so they don't lose their money. Notice who that protects: the lender. It does absolutely nothing to protect your down payment or the equity you've built. That's why there's a second policy: owner's title insurance. This one is technically optional, but I will tell you right now, It is one of the single smartest, most non-negotiable purchases you can make in real estate. This policy protects you. It protects your down payment, your equity, and your right to the property for as long as you or your heirs own it. It's a one-time fee paid at closing that covers you forever. If that contractor with the lien shows up a year after you move in, your owner's title policy will handle the legal fight and the cost. If that long-lost heir appears with a legitimate claim, your policy defends your ownership. Without it, you could be on the hook for tens of thousands of dollars in legal fees, or, in a worst-case scenario, you could lose your home entirely and all the money you've put into it. The cost can be significant, often $1,000 to $3,000 or more, depending on the home's value. But the peace of mind is priceless. In many states, you have the right to shop for your own title company, and getting quotes can save you hundreds of dollars on this single-line item. Now let's move from the essential third-party services into a murkier category, a gray area often referred to as junk fees. These are fees charged by the lender that are often dressed up to look like official, unavoidable costs, but are really just padding for their profit margin. First on the list, the application fee. Some lenders will charge you a fee of a few $100s just for the privilege of submitting an application. In today's competitive market, this is a huge red flag. You are giving the bank the opportunity to earn interest from you for the next 30 years. You shouldn't have to pay them for that opportunity. Most reputable lenders do not charge an application fee. If you see one, question it and consider walking away. Next, you'll see a cluster of fees with names like processing fee, underwriting fee, or administration fee. These are all essentially the same thing. They are charges for the lender's internal staff to do their jobs, to collect your documents, verify your income and employment, and have an underwriter review your file and give the final approval. Now, is this real work that needs to be done? Absolutely. But the fee itself is often just another name for the origination fee. It's a profit center. You might see a lender advertise a no origination fee loan, but then they'll have a $995 underwriting fee. It's a shell game. The key is not to get hung up on the names of the fees, but to look at the total cost of all the lender's charges combined. That's your true cost of origination. Then you get to the really questionable stuff. The small ball junk fees. You might see a courier fee for $50 or $100. In an age of digital documents and e-signatures, what exactly is being couriered that justifies this cost? Or how about a document prep fee? The loan documents are generated by software. No one is hand-typing your mortgage on a typewriter. This is a pure profit fee. You might even see things like a wire transfer fee or an email fee. These are nickel-and-dime charges that a lender throws on the pile, hoping you're too overwhelmed to notice or question them. They might seem small individually, but they can add up to hundreds of dollars. And this is where your power as a consumer comes into play. You have the right to question every single fee on your loan estimate. You can ask the loan officer, "What is this processing fee for? Is it negotiable?" Or, "Can you explain why there's a courier fee when we've been sending everything electronically?" Sometimes, just by asking the question, you can get these junk fees reduced or waived entirely. They know these charges are fluff, and they'd often rather waive a $100 fee than lose your entire loan over it. This is where the real savings are found, not in the flashy interest rate, but in the fine print. And in the next part, we're going to arm you with the one document that exposes it all: the closing disclosure. This is it, the single most important document in the entire home buying process. Forget the pre-approval letter, forget the initial application, forget even the loan estimate we just dissected. This document, the closing disclosure or CD, is the final legally binding truth. It's the closing chapter of the loan application story, and it reveals everything. The loan estimate was the promise, the closing disclosure is the bill, and you are legally entitled to receive it and review it for 3 full business days before you are allowed to sign the final papers at the closing table. Let that sink in. The federal government, through a rule called TRID, has mandated a 3-day cooling-off period. Why? Because for decades, people would show up to their closing, sleep-deprived from packing, stressed about the move, and a stack of papers a foot high would be dropped in front of them. A lawyer would point and say, "Sign here, initial here, sign here." And buried in that stack was a final bill that looked nothing like what they were promised. A fee was $1,000 higher. The cash to close was $5,000 more than they expected. And what could they do? The moving truck was already packed, idling in the driveway. Their old apartment was already leased to someone else. They were trapped. So they'd sign, swallowing thousands in surprise costs. That 3-day rule is your shield. It is your power. It is your legal right to stop, to breathe, and to become a financial detective with one single mission: to place your loan estimate and your closing disclosure side by side and find every single difference. This is not the time to be timid. This is the time to be meticulous, to be skeptical, and to question everything. You are about to sign your name to the largest debt of your life, and these 5 pages are your last chance to make sure you aren't being taken for a ride. So let's open it up. Page 1 of the closing disclosure looks very familiar, and that's by design. It's a mirror image of page 1 of your loan estimate. You'll see the loan term, the loan type, the interest rate. Check them. Did the interest rate suddenly change? Is the loan term still 30 years, not 25? Next, look at the projected payment section. Does the principal and interest match what you were promised? Is the mortgage insurance amount the same? Are the estimated escrow figures for taxes and insurance still in the same ballpark? And then the big one, the number that makes everyone's heart skip a beat: the cash to close. This is the final amount of money you need to bring to the closing table. Compare this number on your closing disclosure directly to the estimated cash to close on your loan estimate. If it has changed significantly, your detective work is just beginning. The rest of the document will tell you why. Now turn to page 2. This is the heart of the matter. This is where the fees live and breathe. It's called the closing cost details section, and it's broken down into familiar categories, just like your loan estimate. Your job is to compare each line item by item. First up, Section A, origination charges. This is the lender's bread and butter. It includes things like the application fee, the underwriting fee, and any discount points you paid to lower your interest rate. Here's the critical rule you need to burn into your memory. These fees have a zero-tolerance policy. That means the amounts listed in Section A on your closing disclosure cannot be one single penny higher than what was quoted on your loan estimate, unless you, the borrower, requested a change. If you decided to lock your interest rate and paid points to do so after the initial estimate, that's a valid change. But if the lender's underwriting fee magically jumped from $900 to $1,200 for no reason, that is not allowed. You have caught them, and they are legally required to fix it and cover the difference. Next, scroll down to Section B, services you did not shop for. This is where you'll find fees for services that the lender requires you to use from their preferred provider. Think of the appraisal fee, the credit report fee, the flood determination fee. You didn't have a choice in who performed these services. Because of that, these fees have a limited tolerance. The total sum of all the fees in this section cannot increase by more than 10% from what was on your loan estimate. Let's put that in real numbers. If the total of Section B on your loan estimate was $2,000, the absolute maximum it could be on your closing disclosure is $2,200. If it comes in at $2,300, the lender is on the hook for that extra $100. They have to give you a credit to bring the cost back within the legal tolerance. This is a common area for mistakes to happen. An appraiser might charge a bit more. A title service fee might be higher than anticipated. But the law says that's the lender's problem to manage, not yours to pay for. Then we have Section C, services you did shop for. This includes things like the title insurance, a land survey, or a pest inspection. The rules here are a little different. If you chose a provider from the list your lender gave you, then the 10% tolerance rule we just discussed still applies. But if you went out and found your own title company or inspector, then that tolerance is unlimited. The lender isn't responsible for cost increases from a provider they didn't vet. This is why, for most people, it's often safer and simpler to stick with the lender's recommended list. As you go through these sections, don't just glance at the totals. Look at every single line. Do you see a fee you don't recognize? A processing fee? An email delivery fee? A courier fee that wasn't there before? Question it. Call your loan officer and say, "I'm looking at line C05 on my closing disclosure. Can you explain this charge? It wasn't on my loan estimate." A good loan officer will have an immediate, clear answer. A shady one will start to stammer. Now let's flip to page 3. This page can look like an accountant's nightmare, but it's actually just a simple ledger. It's called Calculating Cash to Close, and it shows all the money moving around. On the left side, you have the borrower's transaction. On the right, the seller's. Focus on your side. You'll see a summary of what you owe, the debits. This is primarily the sales price of the home. Then you'll see a summary of what you've already paid, or what's being credited to you. The credits. This is where the magic happens. Your total loan amount is a credit. Your earnest money deposit, that check you wrote when your offer was accepted, should be listed here as a credit. Did you negotiate for the seller to pay some of your closing costs? That seller concession better be on this page as a credit to you. This is one of the most common and costly areas for errors. I've seen it happen dozens of times. A $10,000 seller credit is simply missing. Or the $5,000 earnest money deposit wasn't properly recorded. If you don't catch this, your cash to close will be thousands of dollars higher than it should be, and you'll be paying for someone else's clerical error. Go through this section with a fine-tooth comb. Make sure every single dollar you are owed is accounted for. So what do you do when you find a discrepancy? A fee that's too high, a credit that's missing? You don't panic. You pick up the phone. This is precisely why the 3-day rule exists. You call your loan officer and your real estate agent immediately. You say, "I'm reviewing my closing disclosure. In Section A, the underwriting fee is $300 higher than on my loan estimate. Under TRID regulations, this is a zero-tolerance fee. And I need a revised CD with a lender credit for that amount." Use the language. Show them you know the rules. You are not being difficult, you are being diligent. You are enforcing your rights as a consumer. In 99% of cases, a legitimate lender will say, "You are absolutely right. My apologies, the processor must have made a mistake. We will issue a revised closing disclosure immediately." They will fix it because they have to. The law is on your side. This 3-day window is your moment of maximum leverage. Once you sign at the closing table, that leverage evaporates. Use this time wisely. Can and often does save you thousands of dollars. You have successfully navigated the maze of fees and are now staring at the final accurate numbers. You've checked the math, you've questioned the charges, and you've held your lender accountable. The path to the closing table is finally clear. But the journey isn't over. Your signature on that document is not an ending. It's a beginning. It's the start of a 30-year relationship with the single largest financial instrument of your life. In our final part, we'll show you how to manage this mortgage, how to pay it off faster, get rid of PMI, and make sure this home is a source of wealth and security for decades to come. So how do you do it? How do you transform this colossal, intimidating debt into a finely tuned engine for building wealth? It begins the day after you close. The papers are signed, the keys are in your hand, but the real work, the work of mastering your mortgage, has just begun. First, let's talk about the fundamentals of managing this new financial reality. Your first action should be to set up automatic payments. This is non-negotiable. A single late mortgage payment can drop your credit score by 100 points and stay on your report for 7 years. It is the most expensive mistake you can make in your first few years of homeownership. Automate it and eliminate that risk entirely. Next, you need to learn to read your monthly mortgage statement like a financial detective. You'll see 4 key letters P, I, T, and I. Principal, interest, taxes, and insurance. The principal is the part of your payment that actually reduces your loan balance. It's the good stuff, the part that builds your equity. The interest is the cost of borrowing the money, the lender's profit. Taxes and insurance are held by your lender in an account called escrow. They pay your property taxes and homeowner's insurance on your behalf from this account. In the beginning, that I for interest will be a shockingly large portion of your payment. This is because of something called an amortization schedule. It's heavily front-loaded. For the first 5 to 10 years of a 30-year mortgage, you're barely making a dent in the principal. The vast majority of your payment is pure interest, pure profit for the bank. Understanding this painful truth is the key to unlocking the motivation to defeat it. Your first major mission is to eliminate private mortgage insurance, or PMI. This is the fee you pay to protect the lender because you put down less than 20%. It is nothing for you. It's like renting money. The moment you reach 20% equity in your home, you need to get on the phone with your lender and request to have it removed. Equity comes from 2 places: paying down your principal and your home's value increasing. If home prices in your area have gone up significantly, you might be at 20% equity much faster than you think. The lender will likely require a new appraisal to confirm the home's value, which might cost you a few $100s. But if you're paying $200 a month in PMI, that's a break-even of just a couple of months. It is the highest and fastest return on investment you can get in homeownership. Don't wait for the lender to do it for you. By law, they have to automatically terminate PMI when your loan-to-value ratio hits 78%, but you can proactively request it at 80% and save yourself months, or even years, of pointless payments. Once PMI is gone, your next target is the principal itself. Let's talk about paying off your mortgage faster. People often ask, why would I do that when I could invest the extra money in the stock market? It's a valid question, but paying down your mortgage is a guaranteed, risk-free return on your investment, equal to your interest rate. If your mortgage is at 6.5%, every extra dollar you put towards the principal is earning you a guaranteed 6.5%, tax-free. You can't find that in the stock market. The impact is staggering. On a $400,000 loan at a 6.5% interest rate, just paying an extra $200 per month chops nearly 7 years off your loan and saves you over $100,000 in interest. Think about that. $100,000. That's a college education, a business startup, a comfortable retirement, all from the price of a few nice dinners out each month. There are a few ways to do this. The most popular is the bi-weekly payment plan. You pay half your mortgage every 2 weeks. Since there are 26 two-week periods in a year, you end up making 13 full payments instead of 12. That one extra payment a year is applied directly to your principal and can shave years off your loan. A word of caution: don't pay a third-party company to set this up for you. You can do it for free. Either check if your lender offers it directly, or simply divide your monthly payment by 12 and add that amount to your payment each month. Which brings us to the simplest method: just pay more. Any amount. $50, $100, whatever you can afford. The crucial, absolutely critical step is to ensure that extra money is designated as a principal-only payment. If you don't specify this, the lender might just apply it to next month's interest. You have to explicitly tell them, this extra cash is to attack the principal. Another powerful strategy is using financial windfalls. Get a bonus at work? A tax refund? Instead of buying a new TV, consider making a one-time lump sum payment towards your principal. A single $5,000 payment in year 3 of that same $400,000 loan could save you over $15,000 in interest over the life of the loan. It's like a cheat code for your amortization schedule. Now let's address the big one: refinancing. Refinancing is when you take out a new loan to pay off your old one, ideally at a lower interest rate. The classic rule of thumb is to consider refinancing if you can lower your interest rate by at least 1%. But it's not that simple. Refinancing comes with its own closing costs, often thousands of dollars. You have to calculate your break-even point. If the closing costs are $4,000 and your new, lower payment saves you $200 a month, your break-even point is 20 months. You need to be sure you'll be in the house long enough to make it worthwhile. The biggest trap with refinancing is resetting the clock. If you're 5 years into a 30-year mortgage and you refinance into another 30-year mortgage, you've just extended your total loan term to 35 years. You're right back at the beginning of that brutal amortization schedule where almost all your payment is going to interest. The power move, if you can afford the higher payment, is to refinance from a 30-year loan into a 15-year loan. Yes, the monthly payment will be higher, but the interest rate will be lower, and you'll be out of debt decades sooner, saving a life-changing amount of money. As you pay down your mortgage and your home appreciates, you build equity. This equity is one of the most powerful financial tools you will ever own. You can borrow against it with a home equity line of credit or HELOC, which works like a credit card, or a home equity loan, which is a lump sum payment. This can be used for home renovations, consolidating high-interest debt, or paying for college. But be incredibly careful. It can be tempting to use your home like an ATM, but you are putting your house on the line. It should only be used for strategic investments that improve your financial position, not for funding a lifestyle you can't afford. Over the course of this series, we've journeyed from the confusing jargon of the initial application to the hidden traps on the closing disclosure, and now to the strategies that put you in command of your financial destiny. This piece of paper, this mortgage, is not a life sentence to debt. It is a key. It is a forced savings account. It is a hedge against inflation. It is the foundation upon which you can build real, lasting generational wealth. You are no longer just a borrower. You are an informed homeowner, an asset manager, the CEO of your own household. You understand the levers you can pull, the questions you must ask, and the traps you need to avoid. You know how to slay PMI, how to accelerate your payments, and how to make your equity work for you. Don't just pay your mortgage, master it. Interrogate your statements. Challenge the fees. Make a plan. Because the key to financial freedom isn't just about earning more money. It's about making the money you have work harder and smarter for you. And for most of us, that journey starts right here with the 4 walls we are proud to call home.